You know, when we talk about the US stock market, what's the first thing that comes to mind? For most of us, it's the S&P 500. And for decades, there's been one undisputed king when it comes to tracking it. But what if I told you that a massive, behind-the-scenes battle has been raging, and it just hit a wild climax?
So, yeah, the long-reigning king of the stock market? Dethroned, gone. But the big question is, why? How did a younger, leaner challenger manage to finally claim the crown? And, maybe more importantly for all of us, what does this mean for your money?
And boom, take a look at this. This chart, this is the exact moment it all went down. You see that blue line? That's Vanguard's VOO. After a relentless, decade-long chase, it finally, officially overtakes the black line, the legend, SPY. This is the moment it became the biggest S&P 500 ETF on the planet. I mean, talk about a changing of the guard.
All right, so a new king is crowned, the rise of a new champion. And the numbers, well, they don't lie. As of early 2025, VOO is sitting on over $631.8 billion in assets. It just edged out SPY, which is at $630.3 billion. It's official. The king is dead. Long live the king.
Okay, so this brings us to the tale of two titans. We've got to meet the contenders, because, to really get why this is such a huge deal, we need to dive into the story of these two funds. This is a classic old guard versus new blood story, a real showdown between the trader and the investor.
First up, let's talk about the OG, the trailblazer, SPY. I mean, this thing launched way back in 1993. It was the first ever exchange-traded fund in the US. Think about that. For more than 30 years, it's been the heavyweight champion, the absolute go-to, especially for the big-shot professional traders who need to sling massive amounts of money around like instantly.
And then, in the other corner, you have the challenger, VOO. It jumped into the ring way later, back in 2010, and it was built by Vanguard with a totally different game plan. Its whole mission, its entire reason for being, was to do the exact same thing as SPY, track the S&P 500, but to do it way, way cheaper. It was designed from the ground up for you and me, the everyday long-term investor.
So here's the tale of the tape, head-to-head. You've got SPY on the left, the veteran from '93, managed by State Street. On the right, VOO, the new kid from 2010, run by Vanguard. And look at their core identities, totally different. One's the trader's tool, the other's the investor's choice. And then you look at the bottom line, the assets, and you see exactly how this fight turned out.
Which brings us to the big showdown, the fee factor. This is the secret to victory. So how in the world did David beat Goliath here? How did this younger fund overtake the undisputed giant? Well, it all boils down to a few tiny but unbelievably powerful differences.
Okay, so the fight really happened on three main fronts. You've got fees, the legal structure of the fund, and liquidity, which is just a fancy word for how easy it is to buy and sell. Now, SPY, the original, has a higher fee and an older structure, but its superpower, extreme liquidity. We're talking traders moving billions in a heartbeat. VOO's counterattack, a rock-bottom fee, a more modern setup, and still, really strong liquidity that's more than enough for pretty much everyone else.
And this number right here, this is the secret weapon, 0.065%. That's the difference between SPY's annual fee and VOO's super low fee. I mean, we are talking about just over 0.06%. It sounds like absolutely nothing, doesn't it? But trust me, in the world of investing, that tiny number is a literal giant slayer.
And here's why that tiny number is so powerful. Like ETF.com says, these little differences compound over time. You know that idea of a snowball rolling downhill getting bigger and bigger? That's exactly it. That tiny fee you're saving with VOO means more of your money stays in your account, working for you, earning more returns. We're not talking about pennies here. Over 10, 20, 30 years, this can mean thousands, maybe even tens of thousands of extra dollars right in your pocket.
And if you need proof, here it is in black and white. Just look at these returns. It doesn't matter if it's 1 year, 5 years, or 10 years, VOO just consistently, predictably inches ahead of SPY every single time. That little sliver of extra return you're seeing, that's not magic. That is literally the fee difference at work, playing out in the real world, year in and year out.
Okay, there's one more little difference in their DNA, how they're legally built. SPY is an older model, a unit investment trust. Long story short, it can't automatically reinvest the dividends it gets from companies like Apple or Microsoft. It has to spit them out to you as cash. But VOO, being the newer open-ended fund, can take those dividends and automatically buy more shares for you. It's just another small edge that helps boost that compounding growth over the long run.
Okay, so after all that, which Titan fits you? It's time to make a choice. Now that we know the differences, the big question is, which one of these giants is the right one for your portfolio?
You know, the choice is actually pretty straightforward. It just comes down to one question. What's your strategy? So step 1, are you a frequent trader? I mean, are you jumping in and out of the market all the time? If so, SPY's insane liquidity is probably built for you. But step 2, are you a long-term investor? If you're planning to just buy and hold for years, maybe even decades, then VOO's lower costs are literally designed to help you come out ahead.
So let's talk about the investing revolution and what this all really means. You might be thinking, why do we just spend all this time talking about two funds? Well, because this whole thing, it's about way more than just VOO versus SPY. Their fight is a symbol of a massive, fundamental shift that's happening across the entire world of investing.
Yeah, VOO's victory, it's really a victory for all of us, for the everyday investor. It's proof, loud and clear, that costs matter. It's the sign of a revolution that is putting the power and, just as importantly, the profits back where they belong, in the hands of regular people, not just the pros on Wall Street.
But, and this is a big but, don't for a second think this war is over, because there's a third Titan lurking in the shadows. It's BlackRock's iShares ETF, ticker IVV, and it is right on their heels, with almost $610 billion in assets. And guess what? It has that exact same rock-bottom 0.03% expense ratio. Oh yeah, the competition for your investment dollar is just getting started.
So VOO won this historic battle. It took the crown that was worn for 3 decades straight. But the bigger war, the real revolution for low-cost investing for everyone, that is far from over. And it leaves us with one final, really exciting question to think about. Who's next? Who's gonna be the next one to challenge for the throne?